Whether you are a trader who has been in the market for a long time or someone who has just started participating in financial trading, you have probably all heard a very famous saying, which is,
"The trend is your friend."
However, this friend is actually very good at turning against you, as in this situation, and this situation as well. And even though you can see that the trend may return and move in a direction that matches your expectations, by the time that happens, the trade has already been stopped out. Personally, I am someone who has been in the market long enough to understand the frustration that you feel. When you see the price moving upward, you expect a buy trade, but immediately after you enter that buy trade, price pulls back sharply. There have been many times when I ask myself a question: is there a way or is there any kind of signal that allows us to recognize the situation earlier? In the past, I looked at candlesticks, price action, market volatility expressed through momentum and trend strength. I already covered those topics in previous video, so you can go back and watch it. In today's video, I want to take advantage of the strengths of technical indicators to help you recognize when price is likely to reverse, and this will definitely help you understand which areas are zones you should not chase, which areas you should not buy, and which areas you should not sell. Because at those points, divergence appears and price might experience either a strong reversal downward or a strong reversal upward. Before we continue, I want to quickly mention my trading community on Telegram. There are over 700 traders sharing market perspectives. If you are interested, the link is in the description. Specifically in today's video, I will divide the content into 4 parts. First, we will learn what divergence is. Second, we will talk about common divergence cases. Third, we will explore the practical uses of divergence. Fourth, I will share the divergence strategies that I am currently using. To begin, we need to understand the root concept. So, what is divergence? You may have heard terms such as RSI divergence, MACD divergence, or CCI divergence, and many other types of divergence. So, what exactly is divergence, and how can it help us identify the reversal points more effectively? Basically, divergence occurs when the price chart of an asset moves in the opposite direction compared to the trend of an indicator. These indicators are usually momentum indicators, used to detect whether buying or selling pressure is strengthening
or weakening.
One thing I want to emphasize again is that divergence is not only used by individual traders, but also by many other traders worldwide. Even large institutions such as security firms and financial companies use divergence and overbought, oversold conditions in their daily and weekly reports to make assessments and recommendations. To understand divergence more clearly, there are many cases that can easily confuse traders. I understand this confusion because when I first learned these concepts, I also struggled with questions like: when is bullish divergence? When is bearish divergence? When is hidden divergence? When is regular divergence? When is strong divergence? And when is weak divergence? There's too much information, so I will organize everything into a table and divide it into clear cases to make it easier to understand. First, we divide divergence into 2 main types: bullish divergence and bearish divergence. Let's start with the strongest reversal case. For bullish divergence, even though price continues to create lower low and remains in a downtrend, the momentum indicator creates high lows. This shows that selling pressure is weakening and sellers are gradually losing control of the market. Although traders are trying to push price lower, the selling side is losing its advantage. This creates the possibility that price may revert from a downtrend into an uptrend in the future. On the other hand, bearish divergence occurs when price is in an uptrend with high highs, but the momentum indicators creates low highs. This shows that buying pressure is weakening, buyers are exiting the market, and price might decline in the future. In addition to strong reversal divergence, there are other divergence cases with lower reversal probability. For example, in medium bullish divergence, Price creates equal or slightly higher lows, while the indicator shows increasing momentum. Price may still reverse upward, but probability is lower, because buyers may be accumulating near previous lows, instead of pushing price higher. This makes reversal less reliable compared to strong divergence. The weakest bullish divergence occurs when price is pushed lower, but momentum indicators show balance between buyers and sellers. Price may rise if sellers give up or take profit, but the opposite can also happen if buyers exit the market. That is why this is considered the weakest divergence type. Similarly, there are medium and weak bearish divergence. There is also hidden divergence, which is not used to identify reversals, but to confirm trend continuation. In an uptrend, hidden bullish divergence occurs when price creates high lows, but the indicator creates lower lows, suggesting that selling pressure is weakening and the uptrend may continue. In a downtrend, hidden bearish divergence occurs when price creates lower highs, but the indicator creates high highs, confirming trend continuation. That is the theory behind divergent cases. There are many momentum indicators such as RSI, CCI, stochastic, and others. Personally, I find RSI divergence to be the simplest and most effective. First, RSI is a momentum indicator that has been used for a very long time and is still widely used today by both retail traders and institutions. Second, RSI is free and available on all trading platforms such as TradingView, Meta4, Meta5, and CTrader. That is why I use RSI divergence in the examples of this video.